Hi, I'm Phil Grande from philsgang.com. Click the link below for your 10-day free trial. This is now the unfolding of the stock market crash. It's been 1 year we've been doing this. And the idea is not during that 1 year to say at 2 o'clock in the afternoon of February 18th the market's going to crash. No. For me to keep ascertaining the information, the clues, get them together so you understand why we're getting closer and closer to a crash, which we are now. All right, let's go. Okay, so what drove this market from 2008? Two assets. The federal, the Treasury, remember the Treasury, regular Treasuries, and the mortgage-backed Treasuries. In 2008, when the market crashed, they had to do something. So they started to print all this money to go in and buy both treasuries. First, let's take the unsecured treasury, because they wanted to get yields down to create a stock market rally of tech stocks. This is what drove the whole market, tech stocks, growth stocks, not value stocks, because they knew if they tried to go for value stocks, it would never work, because they lost $12 trillion, got wiped out in value in houses and stocks. They knew that nobody would be doing any business investment. It'd just be impossible to restructure a rally using value stocks. They decided we don't need profits. They knew these companies would not have profits for a couple years, the value companies. So they said, let's do what they never tried before. Let's just take the tech stocks and we'll drive them by buying two things. We'll first buy 10-year Treasury yield. That will drop the yield rate down, and Treasury stocks will go, and tech stocks will go up. And that's what happened. The other Treasury they bought was the mortgage-backed security, which would support the housing market, so the housing market wouldn't go down. Okay, so that's what this is right over here, called QE. That's called QE right there. They stopped it in 2012. They started again in 2014. So let's go back to here. In 2015, they raised rates, the short-term Fed rate. The short-term Fed rate, remember what that is. Who controls that? The person that controls that is the Fed. So Yellen at the time started to raise rates. Rates started to go up, okay? By 2017, 2018, rates have gone up big time, okay? I shouldn't say big time, but they had 5 rate hikes. At the same time, what was happening is yields, people were selling. They were selling their treasuries, dumping treasuries, right? And when you sell treasuries, yields start going up because they figured, who wants to own a treasury? I want to be in the stock market, okay? Well, when they got to 2018, yields were too high, and that kills the market. And it kills treasuries, right? So so what happened is 2018 we had a 20% crash right here, because yields were too high. They went from 55 basis points to 300. And when you have 300 high basis points, I mean, that kills the tech market. And so the market crashed, okay? Then the same thing happened in 2020. Everybody called it the pandemic. But what really took the market down, yields got to 190. And then, so the tech stocks couldn't absorb that either, and that's why the market dropped. And then they dropped yields by buying treasuries to 55 basis points. And then we had this big rally to where we are today. Okay, right up here, right? That big, oh, let me get you a better color. That big rally right here where we are today. Now let's go forward from there. So now you know the history. We had the crash in 2018, 20%. We had the crash in 2020, 31%, because the yields were too high on the treasuries. Okay? All right. Now, we're at 190 basis points now, right here. Well, wait a minute. If we were at one, if we were at 300 here in the market crash, we're at 190 in the market crash. Why are we going to be so lucky to think if we're at 190 now, the market's not going to crash? Powell told Congress, because back in 2018 he said that they really, people didn't know. He said, I let everybody know now, so it's not going to be a surprise. What a bunch of bullshit. Okay? That's unbelievable. So the problem is now he doesn't know what to do because he can't raise, he can't go in and try to buy treasuries to get yields down to start another big tech rally, okay? You can't start a tech rally from here. Google and Facebook, you can't get those to go up here because he's got to print money. And that's going to cause even more inflation. And the reason why, since November, remember, since November, it didn't work. November was the last time the Qs would go up. It was in November, remember? So the Qs aren't working. Here's November, and the market dropped. So here we are today. See this key point right here? Remember, the S&P, same thing. When they tried to raise yields to push up the bank stocks, which likes high yields, they couldn't do that either because the economy couldn't absorb higher interest rates, yields, and they couldn't absorb inflation from the printing of money to push up the tech stocks. So now the banks are out and the tech stocks, what are you going to go with? Canoes? We're going to start buying canoes? So we got a big problem. So that's why we're underneath both moving averages. That's very bad. And here's the key. The key is right here. IWM. That one got crunched the most. So the small mid-cap stocks are the most important group because those are where all the action is. Okay, those are small mid-cap, a lot of growth. And they got clobbered about 22% compared to 18% in the S&P, okay, and about I think it was the 12% in the Qs, okay. This is what destroyed the market right here. Now, if this keeps dropping, okay, going down, pulls out this support here, then this market is really going to drop. Okay, big time. So the only way they can save the market is somehow get these guys going back up. Okay, so you saw that wasn't working today, right? Okay. The other thing is they know that the bank stocks are screwed. Okay, the bank stocks, because they know that Powell knows that he can't run the bank stocks up. Because to run yields up, which they like high interest rates, high yields, doesn't work anymore with the banks, right? Now, what they're really afraid of is this. He says he's going to start raising rates. That's the short-term Fed rate. Like Yellen, remember, she raised it. That short-term Fed rate affects every payment you make, car payment, student loan payment, house improvement loan, all those, okay? And when you start raising that short-term Fed rate into this environment, the market's going to crash. He knows that. Now, they asked him the other day, when are you going to start unloading the balance sheet? What's that mean? Well, in 2008, on the balance sheet, he had $800 billion in two products. Now, remember why he buys these products. He buys 10-year Treasury yields, and he buys those to keep yields down, to keep running the tech stocks up. He buys mortgage-backed 10-year treasuries, mortgage-backed 10-year treasuries, because that's what drives housing. That's what keeps your 30-year fixed-rate mortgage so low, and that's why everybody's buying a house. Because when he goes and prints money and buys the mortgage-backed security, he supports the housing market. They asked him, when are you going to start selling those? Because here's what people are concerned about. He's raising short-term Fed rates, and if he starts selling mortgage-backed securities off his balance sheet, what's going to happen? Mortgage rates are going to go through the roof, and the housing market's going to crash, and he knows that. This is the biggest thing he's facing. So here's what we got to do in the next couple of weeks. If you look at the spiders right now, okay, the S&P right here, remember what we said. If it was going to break, the market was going to break at 470 right here. Remember I gave that number, and it did. it would go down. Then I said if it was going to break right here, the market would go down. It did. Then remember today I told you when the market was up, okay, I showed you there was only up by 2 stocks, and I said it's not going to work. It's not going to stay there. It's going to turn negative, right? We're up 500 positive, and I said it's not going to work. Remember I brought to you the Dow 30 stocks? I said there's not enough of them participating. Remember the other day when the tech stock, when the bank stocks drove the market down 500 points? I brought you to the Dow. I said let's go through each stock and see what's making this stock market go down 500 points. There's only 2 banks and Home Depot. And anytime you have 2 or 3 stocks driving an entire Dow 30, that means it's not sustainable. It's not. So that's how I knew that the market was going to go back up right here, 1,000 points. Remember I told you take your profit was going to go up? That's how I knew. And that's how I knew today when I said to you today the same thing. When we're up 500 points, is they're going to give it all back. Because remember you went to the Dow with me, right? And there's only a couple of stocks that were driving the whole market. So where are we now? Well, until he answers, when is he going to start selling the 9 trillion, not 800 billion, the 9 trillion? Now think about that. He had to buy $9 trillion worth of treasuries, secured and unsecured, in 14 years to create the biggest fake bubble in history, the easiest money we ever made in the stock market, because it would just keep going up. Everybody made a fortune. It's over. Now it's going to crash. But remember, they're like magicians. They can keep this thing up. They can keep it up for a month. They can go sideways for a month, okay, which is called consolidation, which I think that's what they're going to try to do. So because this is so serious, okay, they know they're going to have the biggest crash in history. So it's going to happen. We're in the crash right now. It's just a function of when is he going to start selling the mortgage-backed security that keeps the mortgage-backed security that keeps the rates down. Now remember, he says he's going to raise rates. If he starts raising the short-term Fed fund rate, like Yellen did from 2015, 2018, and the market crashed 20% because of it, how the hell can he be raising that knowing what happened in 2018? Does he think he's going to raise the short-term Fed rate? He's going to raise your student loan payment. He's going to raise your house payment. He's going to raise your auto payment. He's going to raise your every payment you got is going to go up. In this kind of environment, are you nuts? But he knows that. It's just, he's at a point right now for 14. They're supposed to do this for 1 year. It's a con game. It's a confidence game. It's over. He just doesn't know how to pull the plug and let the market crash. You just don't know how to. You can't deal with it. So he's going to need a couple of weeks to finally get that in his head to accept the crash. Okay, so that's where we stand. So right now we're going to just stay in the strongest stocks, which are going to be our oil stocks. We've been doing great with those, and we're going to just continue looking for good shorts. And when this market finally takes out its low, and remember the biggest thing you got to watch every day, please, right here, the VIX index. That VIX index is so important because remember, when they got up to here the other day, almost to 30, remember what happened with the S&P. They came in and saved the S&P, remember right here? They came in on the S&P, and remember they drove it right back up. They drove it right back up 1,000 points. The reason why it went up 1,000 points because they knew they were in such trouble that the VIX index hit around this 30. All the hedge funds, insurance companies, endowments, all that would collapse. They would be selling about 75 billion in stock, and there's only 5 trillion liquidity in the market. It would make the market go down 2,000 points. That's what he's facing right now. He doesn't know what to do. So he's going to do everything he possibly can to make sure that this VIX, the fear meter, doesn't get up to here. Okay, that's going to be a hell of a job for him. Okay, so he can't let the market go down because the fear meter will go up and he'll have his big crash. This is the whole thing right here. This is the enchilada. This is the whole game right here. This is the whole game. If it hits at that 30, the market's going to have the biggest crash. If he wants to try to consolidate the market, going sideways for a month or two, he could do that too. Okay? All right. Listen, please, If you're not a gang member, join the gang. And please listen to my radio show and hit on my YouTube channel. Hit subscribe, like, and share. I try to get this in. There's a lot of information here. I try to get it as fast as I could for you, okay? Because nobody likes to watch videos more than 5-6 minutes long. I don't. So, but I just don't know how to cut it down. We got so much important stuff to talk about. So that's the game. This is it. The VIX is your key, and IWM is your key. That IWM, remember, that's the important one because that's the one that got destroyed. That's the indice that got destroyed the most by about 22%. If they're going to rally, they're going to rally off of here. If this continues to drop, that tells you there's not going to be any rally in the market. This is the key, IWM and the VIX. You'll know exactly what's going to go on in the market. See you in the charts.